Welcome to The Explainer. Today we're diving into something pretty different. It's a visual way of looking at markets called market DNA, and we're going to document how it was applied to a WTI crude oil chart. Let's get right into it.
So, what exactly is market DNA? Well, at its heart, it's a method that uses these predefined geometric shapes you see here. The whole idea is to map out a potential market cycle. Now, it's really important to know our job today is simply to narrate what we can see happening, just the observable events, nothing more.
Okay, here's how we're going to break this down for you. We'll look at the visual narrative, then the plan in phase 1. We'll touch on risk and profit scenarios, then we'll see what happened in phase 2. And finally, what comes next along with some important disclaimers.
All right, let's dive into the main event. We're zeroing in on a case study involving WTI crude oil. Specifically, we're documenting a cycle that's been labeled WIT_1_2. So this system is broken down into 4 distinct phases. For this particular documentation, we're going to follow the path as it unfolded, moving from phase 1 straight into phase 2. Okay, let's get to phase 1 entry and planning. This is really the starting point, where the initial setup is established. You could say this is where the entire roadmap for the trade gets drawn up. So here's a great visual for you. It's a simple before and after. On the left, that's the market right at the start of phase 1. And on the right, that's the key event that marks the beginning of phase 2. You can really see the progression. Let's zoom in on phase 1 for a moment. The whole process kicks off right when the price hits what's called the primary entry level, and on the chart you can see it's clearly marked with the letter M.
Now, the plan actually defines 2 possible entry levels. The main one, the primary entry, is M, sitting at $57.666. But there's also a secondary entry, PFC, down at $54.291. It's important to note that this second level is optional, and it's a big part of the system's risk management.
So, we have the entry points. But how does this all translate into a concrete plan? Well, that brings us to the risk and profit scenarios. The key here is that a super detailed plan is laid out before anything happens. It's all about quantifying the trade from the get-go. To make things tangible, the plan uses a hypothetical capital of $100,000. From there, it sets out some really specific risk parameters. You've got things like an expected max drawdown of 5%, and then there are these other inputs, like trapezoid time duration and three triangle domain. These aren't just random numbers. They're key ingredients for the risk calculation.
And this is something we have to point out. This quote on the screen is a mandatory part of the documentation. It says, both trade sizes are calculated using the hypothetical capital, the investor's maximum allowed drawdown, the third triangle domain percentage, the risk coefficient, and the contract size. It's all about laying out exactly how the position sizes are determined.
So, based on all those parameters we just looked at, the system calculates 2 trade sizes. And you'll notice they're equal, each one corresponding to one of those 2 potential entry points we talked about. All right, with the risk side of the equation locked in, the plan then projects 2 different profit scenarios. Scenario 1 is what happens if only that first entry, M, gets hit. But scenario 2? Well, that's the outcome if both M times and the secondary level P of C are triggered.
And this bar chart just makes it crystal clear, doesn't it? It shows you the potential annual returns for each scenario. We're looking at a range from about 13% in scenario 1, all the way up to nearly 30% in scenario 2. It really depends on which path the market takes. So, if you boil it all down, what's the bottom line? The maximum expected total profit, according to this specific plan, is $4,052.
Okay, so the plan was set. The numbers were crunched. Now we get to see what actually happened. Let's watch as the market moves and we enter phase 2. And here it is. This is the key market event that defines phase 2. You can see the price hit $58,824. And in doing so, it has just touched the lower boundary of that shape labeled as the trapezoid.
So what does that mean in practice? It means the first position, the one at level M, was opened. The trade was executed. But you'll also notice the price never dipped down to that secondary PFC level. So that second trade was never triggered. Now that phase 2 is complete, we're at a really interesting point. It naturally leads to the question of what happens next. Where does the cycle go from here? The analysis is now focused on navigating this next part of the cycle. And it all boils down to a pretty simple question, right? Will the next phase be phase 3? All right, before we wrap this up, it is absolutely essential that we go over some important disclaimers. First and foremost, just to be crystal clear, this is not financial advice. It's for documentation and verification purposes only. The system prohibits using leverage above 10, and you should never invest essential personal funds. And of course, any risk management has to follow the specific instructions provided. And that brings us to the end of our documentation for this WTI crude oil cycle. We followed the market DNA method right from the initial plan in Phase 1 through the key event in Phase 2. For more information, you can always visit the website.